So let's see what this could look like for a few different size dealers and dealers kind of in different stages in their life cycle. So this is going to be a little bit overwhelming to understand at a granular level. So let's keep it high level and just kind of try to understand the concepts and where we might fit in some of these examples. And so what I'm going to look at first, let me caveat this with there are a lot of assumptions, and these are general examples, so it could be better nailed down on kind of a dealer-by-dealer basis. So I'm going to start with this dealer that we call the 1,000 account dealer that, during the pandemic was buying and leasing, 500 plus new units a year, which is the third line down, and with cost pressure and no stimulus, starting in, say, 2022, they moved down toward a new norm of buying about 350 new units a year and backfilling their program with recycles, right? So over time, their 1,000 accounts became 600 to 700. So at the top, you kind of see a few of the metrics, assumptions that we've made, the ACV, that's rising, the new units leased, the units disposed of, and then what we're going to call this tax gain on sale. I'm going to talk about that here in a moment. And so kind of following top to bottom, when a tax preparer does your tax return, generally what they do is they start with your book income. So that's what you report in your monthly statements or your audit or review or compilation. And then from there, they factor in tax differences. So you see the book income number down, 5, 6 lines down. And then they factor in tax differences to get to your taxable income or loss. And for many of us in this room, at the car company corporate level, there are two major differences. You've got depreciation expense, which is bonus. You don't take that in your books. You take it for tax. And then you've got what we're going to call this gain recapture on sold units. And we'll explain that in a moment. So kind of looking down the screen there, starting in that depreciation area, if we're electing bonus, our deductibility for depreciation is 100% of all those new units we bought and put into a lease. Not the recycled units. We already took bonus on those. And so for this dealer there in 2018, you had 500 new units put into a lease at $9,000 a pop, $4.5 million in bonus depreciation generated. But when we're reducing our book income by this huge number, we have to add back the depreciation we took for book. We can't take both. And it's already 100%, so we can't take 120%. And so that brings us to our net depreciation number. And then we have to factor in these disposal recaptures. And so we have to add back the book loss that we took before we consider our depreciation recapture. And generally, when you, over time, dispose of units from your books, over time, that's generally at a loss. That may have been thrown through a little bit of a loop with pricing the last couple of years, but generally, that's a loss. So we add those back. That's $490,000 there in the 2018 column. But then with bonus, we can't have our cake and eat it too. And what I mean by that is for units that we've already taken 100% bonus on, we've taken every dollar of expense we can take on those units. And so when we get those units back and liquidate them, at auction or receive insurance proceeds, those are 100% taxable. So we get $5,000 at auction from that unit, $5,000 taxable income, no expense to offset. And see, then we get down to our taxable income and loss. And so, I know that's a lot, but take us back up to 5,000 feet here. What are we seeing in this example? Well, for this dealer, they kind of maintained, maybe even grew a little bit when bonus started in 2018. They were buying and putting into service as many units, if not more, as they were disposing of. So they're creating these big bonus depreciation deductions, and they create a loss in the first 4 years for tax purposes that builds to $3.9 million. That's at the end of your 2021 column. But then at that point, they start shrinking. They're disposing of more units than they're buying. Their recapture on selling all those units that we previously took 100% expense on grows. And all of a sudden, we generate taxable income in 2022. That's $750 grand. The silver lining is we've got these losses built up, right? And so we start chewing through those, and it's not till 2025 that we become a full-blown taxpayer. And so if you can resonate with this example, you might say, oh, okay, I got a few years. Well, when those losses run out, what we've done all this time is deferred the tax. We haven't eliminated it. You know, maybe our BHPH counterpart down the road was paying 100 grand a year for this similar performance. And it's going to hit us in a more condensed manner for a few years. And so that may be a little bit uncomfortable. Place in our business cycle where, you know, we own more units free and clear, that cash flow for us, or we've used some other strategies like reinsurance to maybe further delay that moment. I'm going to look at two more examples. If anybody wants to pause and ask a question, though, please interrupt.
How do you get out of Jack?
You can't. Well, you could underperform. That's one way to do it. But I don't think that's you guys. That's not you guys. So, you know, the.
How far do you got to kick the can? And then you die, and then get reborn in Europe somewhere?
Yeah. Yeah, that's a great question, right? You guys, having somewhat plateaued for a while before you enter that new growth cycle, you're generating a lot of income, right? And you're using other tools to delay that day, but it will come. And so you keep strategizing, right? And eventually that moment will come, but you won't be as leveraged. You'll be more cash flow positive. So, yes, Tim.
Build up their reinsurance program now, counting on the potential sales tax that they'll have to pay in the future. Is that going to help offset that tax liability at that point?
Yeah, so you stole one of my next points, so thanks.
Dang
Tim. No, so I guess the point here is, and there'll be a theme a little bit, we're going to quickly look at a couple more examples, but you know, just because you're comfortable knowing that maybe your day is a few years out, doesn't mean you shouldn't strategize now, because that, you know, a program like reinsurance can not only kick the can on a portion of your revenue down, you know, a decade or more, but also lower it to that capital gains rate, right? Whereas you might be paying, you know, 35% rate personally, depending on your circumstances. So let's look at one more. I think a couple can resonate in the room with this example. So this dealer is a 600 account dealer who plateaued in 2018 and just kind of maintained at that point, right when bonus started. And they began shrinking in 2021 due to some of the, you know, cost pressures, cash pressures. But all along they've been generating healthy book income because they're a seasoned business. They know what they're doing well. And so in this example, you can see at the bottom, they become a taxpayer much sooner. They were generating healthy book income. They did take advantage of the bonus depreciation here for a few years before it began tapering off, but they were disposing of as many units, if not more, than they were buying. And so they're getting hit by these depreciation recapture gains where they're 100% taxable on any proceeds they get from the unit. And so they generate these losses for the first 2 years, and then it only takes a year or a year plus to chew through the losses before they're a taxpayer, absent other strategies, which I know, you know, some are scrambling to do, right, like reinsurance right now. So I think the folks that resonate with this, I've talked to one of them this weekend, it was a surprise, right? And I'm talking about a smart dealer. So One more. This one kind of excited me to put together. So nerdy. Nerdy tax. We're not tax people, but nerdy accountant. So this is the new dealer in 2022. And we'll call it small to moderate size at 20 units a month. But when I say new dealer, I mean that could be someone opening a storefront for the first time or someone pivoting from a retail installment contract to a lease. And what I wanted to examine here, and I think, Chad, it was your idea actually, so I'll give you credit, is whether the strong federal taxation argument for LHPH of a few years ago when bonus kicked in still holds water today, right, as bonus is set to start to dwindle down in 2023. And the answer is a resounding yes. And so what are we seeing here? Well, for this example dealer, there are a few things working in their favor taxation-wise. Right out of the gate, they're buying far more leases, far more new units than they're disposing of, right? The program's brand new. They don't have that many repos, losses coming through yet. They're not generating a lot of book income. I think we know that for those that have started a leasing program or a retail installment program for that matter. I mean, I think Ed mentioned it earlier. You know, it takes a year plus to stabilize, and maybe you're probably going to take a book loss in that first year. And so we get to take advantage of bonus for at 100% for 1 year, and then continually at a lower percent. And we don't have a lot of these gain recaptures. And so this dealer has taxable loss for 3 years, but they built up enough of the loss carry forward to chew through it for years to come. And so what's cool about that is this dealer has a chance to unlock the real profit in the program and get a full cycle on their leases, on their portfolio, plus, to own more units free and clear that are cash flow positive before their day may come to become a taxpayer.